The program you are about to hear is a production of the River's Edge Radio Network. The River's Edge can be heard 24 hours a day with the best in local Pittsburgh music at riversedgepgh.com. The River's Edge, your voice for local music. Enjoy the show.
Hi, this is Zach Bell, the station manager of WCAL, and I'm here to tell you about an upcoming event being sponsored by WCAL, the River's Edge Radio Network, and Placid Promotions. WCAL is proud to be sponsoring Heavy Metal Medicine 3, a free-to-the-public music and arts festival being held in the Nesson City Park Amphitheater on Saturday, April 23rd. This year's lineup features some of the best heavy music Pittsburgh has to offer, including Revival Recordings artist Cabaret Runner, as well as Solarburn, Claymore, Only Flesh, Tartarus, Old Lords, Shadow of Corvus, and more. The festival is set to kick off at 1 p.m. on Saturday, April 23rd. Be sure to follow 919 WCAL and the River's Edge Pittsburgh on Facebook, Twitter, and Instagram to keep up to date with the latest festival information and artist interviews. Stay metal.
Broadcasting from Millvale Studios, this is Funny Money on the River's Edge Network. I'm your host, Tom Henry, and with me today is our guest, Mike Sasson, who is actually a friend of mine and a fellow comedian, and was recently part of the 92.9 morning show. And with us, as always, is our producer, Brian Crawford. And I think we have a good show lined up. I actually, we're going to be talking about energy, and I think you were going to lay it out for us.
Well, I mean, we were discussing, first and foremost, thank you very much for inviting me. This is a lot of fun. I'm looking forward to this. Obviously, Tom, longtime friend here, also a fellow Fox Chapelite, so it's
That's right.
That's right.
Let the cat out of the bag.
There you go.
Early on.
Shady Side Academy and Fox Chapel. We'll keep it up. But the thing that we were just talking off air was the Today Show is about the energy sector. And something that affects everybody, especially if you're buying a tank of gas and everything like that. And you notice that if you go to your local Sheetz, your local Get-Go, that the gas prices keep going down. But the thing about it is, one of the reasons why they say the economy went down years ago was because gas prices went up. You'd think that gas prices going down would actually help the economy, but actually the opposite is happening. People are talking about that this is actually hurting the economy, and it's because it's hurting the energy sector. And doing a little research, there's a lot of companies out there with a lot of bad balance sheets. They're taking on a lot of debt because of the fact of they weren't planning on $2 gas, and
right.
So now all of a sudden they haven't had the income that they thought that was going to happen. But right now we're looking for those energy stocks that are out there, and it's just like everything else. When something's down, there's opportunities to get buys. So
right, yeah, you can be the vulture in there and pick out what's good. Now the thing is, and sometimes you can make enormous returns being a vulture in a down market. But the problem, I think the problem that the price of oil faces are twofold, and it's supply and demand. And the thing is that this does hurt the United States in the way that it seems like the big producers in OPEC, Saudi Arabia specifically, is trying to drive American producers out of business, or at least some of them, a portion of them, so that they can gain market share. This has actually been expressed by them several times. I don't know if that's a good strategy for them. I kind of think that they have foregone so much profit because of this strategy that it's actually probably hurting them more than it helps them out in the long run. But it's hard to say. But the other the demand aspect of the low oil prices, I think, is mainly based on the slowdown in China, and you can see it's not just oil prices; it's iron ore, it's copper, And that's because the demand for those products in recent years was concentrated in China. All the growth in the demand, anyway. And China had a huge construction operation going for years that demanded tons of resources. And suddenly, we see that slowing down. Even though they say their economy is growing at like almost the same pace, it turns out you can't believe anything they say. So it doesn't really matter what they say. You can see that the reaction in the market is as if the Chinese economy is slowing down drastically. And I think it must be.
Well, it has to be when you look at the fact that, you can say anything, but if you're buying less stuff and you're building less stuff, then
Right.
it indicates
Right,
that unless you're just basically making the announcement to the world that, hey, we're done. Everything's done. We've built every road we can possibly build. We've built every house. Everything's good. And oh, by the way, everyone who wants a car has bought one, and they're going to be good for the next couple years. Unless you made that announcement, which I doubt you'd ever
Right.
make that announcement, then pretty much it doesn't matter what you say. It's what you're showing.
Right. It's what you're showing. Yeah. And there are a lot of different things you can look at. One is electricity use in China, which is very carefully monitored by the suppliers. And you'll see that has dropped off very significantly. And I think that's as a result of them having overbuilt and needing a lot less production from their factories than they were producing before. And that's going to cause, it's already causing dramatic ripple effects in the other emerging markets. You can see Brazil's way off, Australia, Canada even, because they're all resource countries, and a lot of that resource demand is from China. So I think that I think that this is going to affect us more directly as time goes on, but we'll see. Maybe we'll get through, but I think China is definitely showing the symptoms of going into a recession at the same time that it had really dramatically overbuilt production. So that's not a good, that means you need a correction, really, I think. So we'll see what happens there. But so I think that oil prices could stay down quite a bit, potentially. But then on the supply side, I don't know what's going to happen.
Now the thing that I've read and I've heard is not only is Saudi Arabia trying to drive down prices to get American or anybody else out of the business, but also geopolitically they're not real happy with Iran and other countries in the Middle East, and so they're trying to actually hurt them and possibly even this is Russia or anything else,
right.
Because they're sitting there going, we've got at least this is what I've read, and they obviously, again, it's like China, whatever you could say anything you want, but they're almost telling everybody, hey, we've got the reserves financially to ride out a storm. We don't believe you do, and
right.
If ultimately we want to control the Middle East and do all that kind of stuff, we're willing to wait it out while you guys are going to sweat, because we're going to drive down oil prices so much that you're not going to be able to finance whatever plans that you have in terms of doing things in Syria or doing things
right.
in Iraq.
That could be part of the motivation. I've heard that before, thrown out there as a theory, and it certainly is like a side benefit for Saudi Arabia to keep the prices low, that it hurts those two countries. I mean, it definitely, Iran is a straight up enemy of Saudi Arabia, and Russia has recently incurred their ire by siding with Assad in the Syrian war, aggressively and bombing the heck out of the rebels who are supported by Saudi Arabia and the United States and other Western countries. So neither of those countries are in their good graces.
So the question is, how do we make money off this?
All right, yeah. How do we make money off this? All right, so you have to look at the individual companies, and we did already 2 shows on the oil majors, and I've already gone over. There are no good deals in that space right now, I'm telling you. So I started to look underneath, what's the next level below, and this is way below. So I'm in the like $10 to $25 billion market cap area here, and for perspective, Exxon is about a $340 billion market cap company.
So we're talking about mom and pops, basically.
Well, these are 10 to 25 billion is a good, strong company. It's just not like, yeah, right. just not as huge. You know, Exxon is one of the greatest valued companies in the world.
Well, these are one of the Exxon's one of those companies that even if you know nothing about business, if you're like one of those Occupy Wall Street people, you hate. Like, right. Because everyone knows Exxon, especially from the Valdez and everything like that. They're just huge, you know. But there's them Walmart are like the definition of just a gigantic company. A gigantic, evil, faceless, evil machine that just gobbles up.
Halliburton, maybe you could throw that in
Halliburton, just because of because our buddy Dick Cheney. Yeah. But I mean, just those. Whenever you say evil, if you were to go down right now to Lawrenceville and Pittsburgh,
BP was pushing it too.
BP was pushing it, but I just think anytime you say British, everyone's like, they're
polite and dirty.
They're politely polluting the Gulf. But the thing that gets me is the fact that whenever you talk about those gigantic companies, you go down to Lawrenceville right now and talk to a guy with a beard down to his knees and say, "Hey, give me an evil company," and he'd be like, "Exxon," and he'd be like, good. So not these guys. We're talking about the companies that possibly are as evil, but just not as big.
Right. In fact, one of them was part of the Deepwater Horizon scandal. I'll tell you about. And in fact, sometimes it's the big companies that are under a lot of scrutiny and therefore have to abide by the rules more so than this second tier. You know, they're not as under and they can get away with more. And I think some of the histories of these companies will bear that out. So let me talk about the first one. This one's actually near and dear to me. It's called Devon Energy, and I was friends with one of the people who got in really early and was on the board of this company. It was founded in 1971 by John and Larry Nichols, who were a father-son duo, and it's headquartered in Oklahoma City. Right. All right. So it was founded in 1971. They didn't really have very much money to invest then, and just to give you an idea of what it's like now they're headquartered in Oklahoma City in the 50-story Devon Energy Center, which is a beautiful place, and it was built in 2012 when things were going better than they're going now. That's one of the problems with Devon. I like the management, but they did time investments poorly. You know, like that energy center would be one. But who was anticipating a price drop off back in 2012?
Well, it's funny you mentioned that. One of the places that I have lived in my childhood was Midland, Texas.
Oh, yeah?
And I remember when I lived in Midland, it was, they talk about the boom days of like the late 70s and early 90s when during the oil embargo, that's when like people were rushing to West Texas, probably similar to Oklahoma City. These guys, everyone was rushing to West Texas to live in Midland and were making their millions. But then when I got there around 85, 86, this was when oil prices were going down. And literally you would go to elementary school and 8 and 9-year-olds would know what the price of a barrel of oil was.
Wow.
Because that's how that they knew that if it got below a certain level, like we'd be eating our, we're drinking our Capri Suns.
I think they should have to know that already, but anywhere in the United States.
But they would sit there. Well, in Pittsburgh, it would be like, price of a ton of steel maybe. But back then, it was literally, you'd be sitting there and they'd be like, I saw under $50. I was watching. My dad was giving. It was every day though. But when it kept getting lower and lower, and people were moving out and everything. So you're right. When you're in those, markets to where you're not Exxon, Mobil, whatever like that, the price of a gallon of gasoline can really affect you. And so I can imagine these guys kind of were hit with the same type of stuff.
It affects those big companies too. But it might even be more of a hit to these smaller players. But this one, the very next one we're going to talk about is headquartered in Midland, Texas.
Really?
Yeah. So we'll get to that. All right. So this is a father-son duo who founded this company in the 70s. It went public in 1988, and at that point it was mostly a gas producer. But now it's more evenly balanced. Its production is 43% oil now, so 57% gas. But if you actually look at the revenues, the last quarter was 90% oil, and that's because of the proportion to gas of the decline in the price. We think oil has lost a lot, but gas is even worse percentage-wise. So oil is still significantly more valuable than gas per barrel of oil equivalent. All right. So it's actually a good thing that they're more into oil, even though oil's obviously not great. It's one of the largest producers in the Barnett Shale, which is like north central Texas and southwestern Oklahoma. That would be, they've got now. They didn't. Their earnings were negative last year, so to say the PE would be ridiculous because it's infinite. So you generally just say not applicable. So there's no PE. The ROIC, that's another thing we talk about on this show. That's return on invested capital. Over the last 1 year was negative 53%. Okay, that's like beyond mind-blowingly horrible.
But then the answer to the question, I'm listening. Why do you trust these? Is it because of the management?
Well, I'm not saying I like this company.
Oh,
I'm just reviewing it.
You're just reviewing it.
Yeah.
Okay.
We're just picking out some that are that are interesting, but and representative of this segment of the market, but not necessarily the cream of the crop. Although these were like the best 4 that I could find, really. Unfortunately,
Best of a bad group.
and I looked around a lot too.
You made the attempt, and these were the best of the bad group. It's like finding the best players on the Cleveland Browns.
Right.
There are good. You can be the best in that locker room, but just not outside of that locker room.
Right. That's a good point. So they cut their dividend, from 24 cents just now to 6 cents. The dividend yield is 0.92%. That still leaves a little bit of a dividend. Net debt to equity. Now, this is a problem. Their debt to equity is too high. Debt to equity, you should always have less debt than you have equity, in my opinion. I mean, and I don't like to see a company really that has, I put up a little red flag when I see a company that has over 60% debt to equity. Because what you're saying there is that maybe my assets couldn't even cover my debt.
Meaning tomorrow, if they just said, okay, we're going to pay off all of what we owe. Let's sell everything that we'll sell the building. We'll sell all the trucks. We'll sell all the oil wells. We'll sell everything. And right now, if it's at 60, that means that they could do it. Then they could still have 40%.
Do it and have 40% left over.
Now, are there some in the list that are, when does it get bad?
Okay. Now, see, even at 157% net debt to equity, you could still do it, because if you have any positive equity, it means you have theoretically enough assets to sell to pay off your debt. All right. But the problem is the theoretically part. It just, because sometimes when you go to sell off your assets, the market stinks and you can't get that money. Just because, very often in the times when you are forced to sell your assets is like at the nadir of the market, like the worst time to sell. So, and that's not a coincidence, obvious, because the oil companies are struggling really hard right now. It's going to be harder to sell oil assets because they're producing an asset that isn't worth nearly as much as it used to be.
So for instance, like if you said, okay, they're going to sell this building that they just produced, but the problem is that no one wants a gigantic office tower in Oklahoma City if the only people that would possibly buy it would be oil and gas people.
Exactly, right. And it's recorded on their balance sheet at cost.
Yeah.
So, right. You might not be able to sell that thing. For instance, for full price.
Yeah.
Right, and that's just an example.
Yeah.
But because the vast majority of their assets are, oil producing land and gas producing land. That is too high a debt level compared to equity in my book. 157%. So what that means, the equity is the assets minus the liabilities, and the debt is part of the liabilities. Mm-hmm. And you're just saying, so if I took the debt out separately and compared it to the whole assets minus the liabilities, what would that be? But if there is any positive balance between the assets minus the liabilities, theoretically, you should be able to pay off all your liabilities. But as I say, it doesn't always translate into reality. So you want a nice buffer That's why I like to see debt to equity below 60%.
And this is a publicly traded company.
It is a public.
So you have to see this.
Yes.
Now, if it's a private,
they don't show, right. They generally will not show you the information.
Now, then a privately held oil and gas entity, would you just stay completely away because you have no idea? You'd have to assume.
Yeah. Depending on how much information there is out there. Some companies release information more than others. Like if they're in an acquisition or something like that, they have to release it. And sometimes it gets out to the public and stuff. So that's a good point, though. If I look at this company, another way to look at this is that in their December quarter, which is the quarter that ended in 2015, they lost $575 million. Or another way to put that actually is their free cash flow was negative $575 million. And so that's an important thing to look at. I like to look at that because it doesn't have anything to do with balance sheet losses that don't really affect the money that I'm holding in my hand, So this 575 rate, 575 million December free cash flow, and they've got 2.3 billion on the books. Well, if they ran at that rate, they would obviously burn through all of their cash and then some in 2016. So that would indicate that, like, if oil prices stay the same and gas prices stay the same, then they're going to have to be forced to borrow more,
which is going to increase their debt and which is going to all that kind of stuff.
Or do something else, or sell
a division, or
assets, right. Somehow raise money, sell equity. But all of those are bad options. And the earnings per share are expected by the analysts to be negative $1.25 for 2016. So it's a very dark story, and it would be hard to stomach buying this one. You could do it as a very aggressive play. It's trading at $25.73, which is down from $80 2 years ago. So, this stock has really suffered a lot. And its book value per share, which is the equity divided by how many shares there are, is $16.86. So you do have some support there. It's not that far below what the stock is trading at. Anyway,
so this is what if they just sold everything, the stock would actually be worth $16.
Theoretically, right? If
and
they
it's
sold,
trading at 25, you said?
Yeah. If they sold everything and they got what they thought they were going to get for it, then that would happen.
You'd rather see the opposite. You'd rather them saying if we sold everything, it'd be 25, and then the stock is at 16.
Oh, much.
Then you'd say
right. It's trading at a discount to book.
Yeah,
right.
Then you're saying, go get that.
Right. Generally, but there can be reasons why things are trading at a good discount to book, and that's because people don't believe the book value.
Okay.
Right, and that happens a lot. Not a lot, but it happens with banks a lot. I think right now Citigroup is trading below book. So yeah, this company, to boil it down, they have good management. I can tell by the way they're addressing this problem. It seems to be accurate. They were early cut their dividend. They've been trying to save cash, but they really made some very poorly timed investments, and that puts them in a very difficult position. They just announced plans to lay off 1,000 of its 6,600 employees. They reduced their drilling budget by 75%, which totally makes sense. Why drill new wells now? And they are in the process of selling assets to raise cash. All right. So I would say take a pass on that one. That's too difficult to swallow. I think that one, I suspect that it's going to survive, but I think that there's a pretty healthy chance that it doesn't. So I'd stay away. It's not worth that risk. Next one I want to talk about is called Concha Resources, and this is the one in Midland, Texas.
All right.
All right. This is a recent company, so it wasn't operating when you were there. It was founded in 2004 by a group of investors, and what they did is they snapped up $117 million worth of oil and gas properties right away. I forget who they bought that from. I think it was Chase Oil and Gas. I was wondering if that's part of J.P. Morgan Chase. The company went public in 2007, and it's headquartered in Midland, Texas, which we already said. So, what is that place like, Midland, Texas? Is that like a town, like, or a city, or how would you describe it?
Well, it's about 100,000 people when I was there. Mm-hmm. So think about 100. I mean, think about. I'd imagine it would be like if you were in, let's say, Altoona, Pennsylvania. Only it was really, really nice. Okay. Because there is money there. Yeah. There's money there, but it's like that.
Hey, they got a Sheets in Altoona. Nice Sheets.
They have wonderful Sheets in Altoona. Altoona that's the home of Sheets. But like the way I would describe it is, number one difference between like small towns, let's say in Pennsylvania, Ohio, or anything like that, is that like Altoona or towns like that, Johnstown. Let's just say Johnstown.
Wasn't the Starkist guy named Al? I just thought of something hilarious.
Really?
No, Altoona.
Really? Yeah. Let's define hilarious later. But it's the thing that the difference is like with towns like that is it's the Fox Chapel of West Texas, because there are these other little towns like Odessa and Big Spring and everything like that. Mm-hmm. But you're 6 hours away driving to Dallas. You're about 8 hours away from Houston. You're about 5-6 hours from El Paso. The closest town that probably anybody's ever really heard of is Lubbock, because of Texas Tech University. That's maybe about 4 or 5 hours. But they feel that they are a bigger town than they are, because they do have a little bit of cash. Right. Like there are some nice like golf courses there and everything like that.
Right, I believe
because of the because in their little sphere, like if you go to Odessa and you say you're from Midland, it's like going over to Shaler and saying you're from Fox Chapel. It's like la-di-da, you're from the rich part of the town. But you're so far away from bigger cities that you're kind of just isolated. So
what are the people like? Are they all like the Beverly Hillbillies?
No, because here's the thing about there are some here's the thing about Texas that I noticed. About 70% of the people are like from Pittsburgh. Yeah. They're like from Chicago. They're from New Jersey. They're from Georgia. They came there, and stuff like that. Now, the 30% are the old school, like Texas people that like wear the hats and everything that. And they still do exist. It's like coming to Pittsburgh and saying, well, do Yinzers exist? Yes, Yinzers do exist, but you can go to other places and get people that are coming for the university or for hospitals or whatever like that.
And it's a constantly shrinking demographic.
Yeah. So it's a different type of town. I mean, like, for instance, most of my friends that I hung around with did not have a noticeable huge Texas accent. Now, some did. And those were the ones that were like I remember talking to one of my friends, and I was like, when I moved here, I thought everyone rode horses to school. Like, no, no one since my grandma's rode horses to school. And I remember one time that my dad's business that he had there, he was the sales manager for the Coors distributorship there. Yeah. And my soccer coach was a big Budweiser drinker. Now, I'm 8-9 years old on a soccer team. You'd think you'd keep that out of a conversation with a 9-year-old. This is all the conversation I had with this man. Was he would sit there and be like, oh, Mike, I don't feel good. My stomach's a little, you know what happened? Last night I had a case of Coors and, it didn't sit no well. Tell your daddy that, I got to stay with Budweiser because this Coors ain't sitting well with me. And I'm like 9 years old playing halfback on a soccer team. I'm like, okay, all right. But
I'll pass the booze message on.
Yeah, I'll pass that my dad, apparently the booze is not sitting well. But there's a minor league baseball team. At the time, it was the Midland Angels. Right. They were a AA team. So again, like Altoona has the Altoona Curves, stuff that. So, it's a place that I'm glad that I experienced because, especially since it wasn't Dallas. Like every time I went to Dallas, I felt I was in it wasn't Texas because I'm fake or it's like going through Cranberry Township forever.
Right.
I mean, it's just it's the same thing with Houston. It's big but again now
strip
everybody
malls the same
same Applebee's, same strip malls, same Sunoco, same 7-Eleven, same everything like that. But at least in Midland, I had a little bit of Texas, culture still surviving.
The real deal.
The real deal. But again, at the time, the thing that hit them was the fact that the oil prices were getting so terrible that it was really hurting the economy. So it was it was weird because I had lived in Pittsburgh when the steel mills were going down and everybody was depressed. Then I moved to Midland. The oil prices were going down. Everybody was depressed. So maybe I'm the jinx guy. I don't know. But it was interesting. I'm here now and everything's booming. That's right. Getting hipsters and hospitals and all that kind of good stuff.
All right. So let's talk about Concho Resources. This company went public 2007, and it's been around. This one actually had positive earnings for 2015. Okay, not very positive, but hey, that's a big difference.
In this economy, in this market, you'd have to think that that's great management to be able to turn a profit when everyone else is going down the tubes.
Plus, you have to understand on this show, Mike, it's very negative. It's always don't buy, can't invest in this.
Pretty much. That's the way it's been.
That's the theme, yeah.
Well, and to be honest with you, the one guy that is the most famous guy that kind of does what Tom's talking about is Warren Buffett, and he talks about the fact that he isn't investing in companies every single day. I mean, it takes years.
No, he's just randomly. I mean, he'll find a company. He calls it. He loads his elephant gun.
Yeah,
and looks for one big acquisition.
Yeah,
but it's not like people talk about like a Gordon Gekko, like in the movie Wall Street, where he's constantly buying stuff, constantly flipping. He's not that, and I guess the point is for this, if this is for an investor that is looking for something that he hits on long term.
That's right.
Yeah, this is
not a long buy and hold.
Yeah,
right. You're gonna have to stomach some more low prices.
Yeah, this is not This is not get slick back the hair.
No,
and
this is not get rich quick.
Get rich quick and just run around and start going buy, sell. This is not. This is not that. That's on another network.
Yeah. So, all right, the PE is 200.
Okay.
All right, so that's very high PE. The stock price is 105.37, and that's down from 150 back in 2014. So you can see the stock price hasn't come down nearly as much percentage-wise. Whereas Devon's about 30% of where it was. This one's about 66% of where it was.
Why is that?
Well, because their balance sheet is stronger. It is really my.
They didn't build a giant building in the middle of Midland to
right to show off. And their balance sheet is stronger, and it's significantly stronger. So I think that's the main reason, because they're viewed as someone who's much more likely to make it through the other end of the storm. Now they have no dividend, so the management's already cut that, which is a good sign in my opinion. Return on invested capital is actually a positive 0.68, which is excellent for these energy companies. I know that sounds horrible, but to have a positive ROIC is actually really good in this market. Net debt to equity is 36%, and that's one of the things that I really like about this company. That's a very comfortable level, even in good times. I would be, in other words, I would be impressed with a company that had that level even in good times. So to be,
if we had $4 gas, you'd be sitting there saying that's still good.
So to be doing this right now is very impressive. So that's a good sign about the management too. December free cash flow was negative $152 million, and they have $881 million in cash. So
they have less as the other one. The other one had 2 point something billion.
The other one had 2.7 billion, but the other one lost 575 million in cash in December, and this one only lost 152. So this one could go through 12 months losing 152 each month and not exhaust its cash stockpile in 1 year. So that's way better. But they're expected to lose 42 cents in 2016, 42 cents a share, which is significantly better than the loss of $1.25 that Devon was expected to have. And also their balance sheet is actually even a little better than this, but I'm using their official numbers, but I know it's better than this because they just sold a property in January for $290 million cash. So they actually have over $1 billion in cash.
So one of the things that you want to see from a management team that is in bad times as they're starting to, I mean, the other company was cutting staff and everything like that. These guys, they're trying to build up their balance sheet to kind of get through what they think is going to be a tough 2016.
And I read the article about this specific deal that got them to $290 million, and they got a good deal. That was a really fair price. It wasn't a bargain discount price. Very good deal. So they were still selling. I mean, that's like what it would have gone for before in 2014. That's ridiculous. So they did very well selling that asset. And it indicates that they're good deal makers too. So that one is very interesting. So I put that down. Also notable, the book value is $53.76 a share. Stock trades at 105, so it's trading well above book value. All right. So, but I'd put a mark next to it. I think it's too early to get into these companies right now, but I would come back and look at this in a couple of months.
Well, let me ask you a question. All right. So let's say you're in your business. Mm-hmm. You're interested in putting some money down. Would you actually get on a plane and fly to Midland and say, take me around if you're really looking to invest with one of these guys? Or can you make a decision based solely on the numbers?
No, I'll make a decision based solely on the numbers unless it's a private equity deal, and then I'd go. Because if we're just going to acquire some shares in a publicly traded company, first of all, they're not going to give you access the kind of way that they would if you were a serious acquirer. And secondly, like I think that you have to make decisions faster because the market moves fast. So and I think you get good information. There's good information made public by every company publicly traded every quarter. Arguably except banks, in my opinion, but
that's the second time you've mentioned banks. It's kind of like they seem to be like a thing in your craw. Are they?
It's just that their balance sheets are so opaque. Like a company like this, you can see what assets are on their balance sheet, and they're real. But a bank, these big banks, since the crisis, they got to mark down. They got to mark their assets as like hold till maturity, which is a categorization that means I'm not going to value the asset at what I could sell it for right now. I'm going to value the asset at what its principal plus interest are. And you can only they changed the rules to allow them to do that specially in 2008, 2009. And I think that already before that, their balance sheets were opaque because it just says loans. There's just a line that says loans, and it's this huge number. I don't know what kind of loans those are. Tell me. Are they good loans? Are they bad loans? Are they subprime? What's the deal? I don't know. That's part of it. That's part of it. And the other thing about these weird assets that they hold that I'm not sure are valued correctly is part of it.
So, I mean, listening from someone who isn't necessarily the biggest investor in the world in me. Now, what I'm hearing is obviously we're talking about energy stocks in a down market. So it's one of those things of like, is this even the time to get into this because you're sitting there? But just like you say, if you hit the right one that's at its lowest point and you wait it out in 2 or 3 years, something that you bought for $100 might be worth $500 in a couple years. So that's the whole point. That's what you're trying to find, that market. Like this last one, you're sitting there saying, hey, these guys, great, good management, good balance sheet, might be something to look into in a few months and that kind of stuff. And now we just mentioned, and I'm just hearing the tone of your voice, banks, you're just like run screaming in the other direction. What other businesses would you say, let's not get into what you would do, what businesses flat out, if someone came up to you and said, oh, what are some businesses that are in the same category as banks that you're just like screaming in the other direction?
Oh, well, that's a good question. I mean, I have felt that way in the past about airlines, but I don't feel that way anymore. In fact, I have American Airlines. I like it. I like that stock a lot. There isn't much. I think banks, maybe like some sort of like public-private partnership I would worry about, that the government would be stirring things up. Like Rio Tinto in Brazil. Mm-hmm. That would be an example of that. But other than that, you really, I mean, banks is really the one thing that I think is really inappropriately reported every quarter. I think it's too opaque. Their reporting methods are too.
So someone comes up to you and sits there and says, all right, energy stocks in a bad market or banks in general. You're saying I feel more comfortable in the energy market because of the fact that even though it's down, even though things don't look real good right now, I at least trust the numbers.
You can assess what they are. Yeah. So to a certain extent, yeah, but I mean, I can assess, like I can see the numbers, and it's really risky, with Devon, for example.
But at least you're getting a knowledgeable,
right.
You're knowledgeable, you're taking an investment from a knowledge standpoint, as opposed to, like you said, in certain businesses where you're just like, I'm just throwing darts at a board and saying, oh,
right.
I hope.
Okay, yeah. Another example, actually, of something like that, and this is dumb that I didn't answer this right away, is Chinese companies. Okay, I don't trust their numbers. I think that so many of them have been investigated for corruption and have shown to be cooking the books or keeping multiple sets of books. I don't trust their numbers, so I do not buy them.
Now, every other Western European, would you trust their numbers?
Yeah, for the most part, yep.
So so if someone says, okay, I've got a great Australian company, I've got a
no
great
problem.
German company,
No
they're all
problem.
like, great. The only company now, any other nation similar to China where you're sitting there going, this is...
Well, there are probably a lot of nations similar to China, but China's the only major market that I really worry about. Not knowing what the company, I'm buying.
Would India be in the same boat as the Western Europeans?
India is, more in the same boat as the Western Europeans. I've bought India. I bought Tata Motors before. I don't doubt their numbers. I've never heard of problems with the Indian numbers. For some reason, China has lots of problems.
Well, they claim they claim that they're going great when they're buying less steel. So let's just be honest, they're cooking their nation's books.
They are, for sure, right? And then below them, so the private companies are doing it too, and their private-public partnerships, which they have tons of. So, all right, let's talk about the next one. The next one is that one, okay, is pretty good.
So right now, what are the two? The first one, what was the name?
Devon Energy.
Devon Energy, we're saying run away until they blow up that building in Oklahoma City.
Right.
Next one.
Concho Resources.
All right, in Midland, Texas. You're saying that's put a star next to it. It might be something someday.
Right.
4 months from now. Check after Q1.
Yeah. Maybe in a quarter, right. So next one, Anadarko Petroleum. This one was founded in 1959 as a subsidiary of Panhandle Eastern Corp Pipeline Company. All right. After large amounts of gas were discovered in the Anadarko Basin, and that's like Western Oklahoma and the Texas Panhandle. That's why that company was called Panhandle. It actually is huge. It extends a long way. It goes all the way up into southwestern Kansas and southeastern Colorado. Mm-hmm. Anadarko is headquartered in the Woodlands, Texas.
So outside of Houston.
Okay. They were on... this is the one that was on the wrong side of that Deepwater Horizon fiasco. Right. They had a stake, I think, and they had to shell out $4 billion as a result. Pretty significant.
So had to write a check for $4 billion.
Yes. Correct.
It's cool that they were at least able to do that. There you go.
Yeah.
They had $4 billion in one, at least in the day.
They did have $4 billion. So that was in 2014. The PE is NA, meaning they had negative earnings last year. The dividend is 0.41%, so not much. Return on invested capital, negative 21.1%. So obviously, we're back in the negatives. We're a lot worse than the Concho on that, but better than Devon. Net debt to equity, 115%. Too high. Not as bad as Devon, but too high. December free cash flow, and this is worrisome, negative $949 million. And they only have $939 million in cash.
So currently. They lost, you're saying in 1 month, in December 2015, they lost nearly $1 billion.
In cash, yeah. Yep.
And they sold, and they had to sign a $4 billion check before. So
yeah, I know. It's rough. Okay, and they only have $939 million in cash right now. So
Well, it's at least March, so that sounds like they found some
they
money.
must have gone out and borrowed or sold assets or done something, right? The book value per share is $25.22. The stock trades at $48.71, and that's down substantially. That's down from $110 in 2014. So they have they're expected to lose $3.35 this year. That's steep. That's the biggest loss anticipated for any of these. Okay, this is kind of a no-brainer. It's very much similar to Devon.
Now let me ask you a question and go deep. Why? Why is it that seems like the Midland, Texas company, they seem to be okay? These guys, is this poor management? Is it they were in the wrong businesses? Is it the $4 billion they had to sign a couple of years ago? I mean,
I don't know. I'm not familiar enough with Anadarko's management to say for sure that it's poor management, but I mean they were investing heavily right up until the last minute. Not quite as bad as Devon, but very close.
So you're saying these guys...
These guys were more cautious.
These guys saw maybe over the horizon, something's coming up. Let's pull back the reins. Let's start stowing some cash away. Let's be a little smarter. These guys are like, no, spend, acquire, right to the moment that they saw, they drove by their gas station and saw $1.98 gas.
It's more or less that difference. Yeah. All right, now, let's talk about one more. Now, this one's really interesting. Okay, this is Hess Corporation. You may have played with those toys if you're a little. Like,
well, I remember they're big. I believe the guy used to own the New York Jets. Like he was an investor.
Leon Hess.
Yeah.
Yeah. Yep. I think you are correct. He did own the New York Jets. And Leon Hess actually came into the company a little later. This company, the roots go back a long time to 1919. And it was founded by a British national, a Lord Cowdray, which is weird. I've never heard of that. Cowdray. Formed a Merida Corp, okay? And this was to explore for oil in North America. All right, now, and the company was doing okay, no great guns, and then they really struggled in the Great Depression, almost went under, but they made it. And then they got huge. They grew really robustly, especially after World War II. When there were boom times, price of oil went up. Lots of people were driving as opposed to in previous years. Obviously, during the war, there was a lot of oil necessary. But during the war, the British government actually took part of the company, made it acquired part of the company. So in order to supply the soldiers and whatnot. So this company, okay, Merida, had been around for a long time, and then Hess Oil and Chemical was like a refiner, which is different. The other one is an exploration and production company. Hess was a refiner, and this was founded by Leon Hess. And so Leon Hess this company, Hess Oil and Chemical, bought 10% of Merida after the war, because that was the stake that the British government acquired, and they were selling it after the war. They didn't need it anymore. All right, so they got that stake, and then 2 years later, 1968, the two companies merged. All right, and the company became Merida Hess. All right, in 2006, so they went for a while as Merida Hess. They changed the name to simply Hess Corp. Now, looking under the hood, the PE also NA because they had a loss last year. Dividend, 1.93%. Now that jumps out at me right away. I mean, it's much different than the others. The others are like trifling little dividend or no dividend. All right, so that indicates that this company is not that concerned about cash. And also that if it had to cut cash, it could cut the dividend, which would bring it substantial amount of cash. ROIC for last year was negative 11.1%. So that's bad. It's better than it's worse than the company that made money last year, Concho. But it is less negative than the other two that lost money, Devon and Anadarko. Now, here's the thing. The net debt to equity is only 20%, which is great. I'm very impressed with a company that could have that in this kind of market. December free cash flow was negative $312 million, and they have $2.72 billion in cash. Okay, so that's not too bad. They could make it through the year. It's funny how our sites are so low. However, this one is really bad. They're expected to lose $6.02 in 2016. So that's the biggest loss of any of these. And a lot of that, I think, is because of where their operations are. It costs a little more than some others. You know, like if you're drilling, it could cost you, on average, if you average out all the costs of the drilling and everything, $50 a barrel to produce a barrel of oil. But if you already have a well drilled and you're just talking about continuing running it, well, then it could be $20 a barrel. You know, so that's why the price, the oil production hasn't decreased that dramatically, because it's still okay to produce at $20 a barrel. Right.
They're just not drilling new ones.
Not drilling new ones.
Now, when you say that they're where their operations are, is that because like what part of the world they are in, or where they go for their oil, or?
No, I think where they are is mostly in the Permian Basin, which is going to be a little harder to frack. You know, I mean, it's a little more expensive than some other places. It's not like the worst would be like the Canadian oil sands. There you'd probably have to still, no matter what, you probably have to pay about $50 a barrel to get a barrel out. And so, and you're, you know, obviously if the price is
so where they are in the Permian Basin, which is again Midland, because I remember from when I grew up there. So that's that area. You're saying that it's expensive to extract that type of oil or that type of natural gas.
Their production costs are higher than like if you were getting it from the Bakken Shale, which I think is like very close to the surface, very light crude, but it's still relatively low. I mean, compared to all production in the United States, not compared to all production worldwide, because then there are countries like Saudi Arabia that, you know, we don't know what their cost of production is, but there are estimates and they're like from $6 to $13 a barrel. You know,
because it's just the type of oil or the type of land that they have.
Yeah. I mean, I'm not a geologist, but yeah.
You're not?
Hell no. I mean, fracking's a different process. They use traditional drilling in Saudi Arabia. You know, fracking is like you're gonna have to spend more because you're gonna have to like break up all the rocks to get it all in one place.
And it's chemicals and pumping all that kind of stuff down there.
Put chemicals in there. It's mostly just water, but so you need some chemicals.
So here's what I'm hearing of the four. I mean, this one's interesting because of the fact of, number one, the fact that they do seem to have a decent amount of cash on hand.
Yeah.
And they only lost 300 some odd million in December. So like you said, they could get through, whereas some of these like numbers, they're just like, you don't understand how they're still, you know, they turn the lights on today. But the simple fact of the matter is, on top of that, you're saying that they're expecting a 6%, what'd you say, $6 drop?
$6 loss. $6 a share loss.
When everyone else was talking in a $1 or $2 or $3 or something like that.
Right.
So that's the thing about it. Some of the aspects of their balance sheet, you're sitting there going, I like this, but then other aspects you don't like. So overall, what are you thinking about this?
Overall, I like this one the best.
Really? Okay. Even though they're looking at $6 per share?
Even though that. Because the balance sheet is strong. All right, let me tell you a little more. Okay, this trades at a little under $52, which is down from $100 in 2014. So, you know, it's a 50% loss. That's pretty substantial. Here's the thing. Book value per share, $67.77.
So this is what I was talking about before, yeah.
The one that trades at a discount to book, exactly what you're saying.
Now, what caused that?
What causes that is that people don't believe the book. They know that each year, all energy companies have to reassess their assets. So they revalue them, okay? And they have to revalue them based on what gas and oil prices were for the last 12 months. So if you're going to say over the last 12 months, my price of oil was $42, the average price that I got over the last 12 months. And then, but right now, it's valued at the 12 months before that, where it was $70 a barrel. So the difference in the value of my assets is going to be dramatic between if I'm valuing everything at $70 a barrel, and the vast majority of these companies' assets are all oil in the ground, gas in the ground, versus if I'm valuing it at $42, $43 a barrel, which would be about the average for the last 12 months. So, but fortunately for Hess, they're one of those companies that they did their value revalued in 2000 at the end of 2015. So they don't have to do it again until the end of 2016. Chevron is a company that has to do it June 30th. And I'm short that company. I'm waiting on pins and needles to see how far they have to write that thing down. I know it's going to be bad. But so, in other words, people don't believe the assets are worth less than what they are recorded for in the book. And the fact that they're expected to lose the $6 a share also tends to make them sell below book, because people are anticipating the book to get worse if they lose that much money. So nonetheless, I still like it the best because the book is that much better than the others. The only other one is Concho, and that's it. It's worth looking at. But this one, I am 100% sure is going to make it through to the other end. You know, that's the main thing I'm looking for. Who's going to survive? This one will.
Because you put the money down, you say, okay, it's eventually all of these things are going to trend up. You're going to own it when it was at 67, when it's back to being 150.
Right, right. You're golden. Now, if it's your opinion though that oil is going to stay at $30 to $40 ad infinitum, then you don't buy any of these things ever, because they're just. I mean, until like a whole bunch of them go out of business and the market reforms or something. But too many of these companies have been set up to rely on higher prices of oil.
So what is going to be the ultimate driver for that to change? Is it going to be China getting its economy together? Is it going to be the something in terms of the world stage happening? Is it going to be? I mean, what?
I think what you nailed it. I think it will be China's economy improving. I think China needs to go through a recession. It's not the end of the world. I wish the government would see that over there before they do something really stupid. But they need to go through the recession and come out the other end, and then their demand for oil will be again robust. I mean, unless the government screws it up really bad somewhere along the way, which is possible. But I think that will be the end of it. On the supply side, whether the Saudis keep producing at a really high level or decide to cut back, that's all that matters. But to me, it's just a very transitory, temporary kind of thing.
The big deal is how much China or other developing nations, but number one, China would be looking at in terms of their production, because they're what's driving all of this.
Yeah, I mean, there are two drivers: the supply side and the demand side. But I think that the stronger driver in the longer term is going to be China. I think it's quite likely that in the June meeting for OPEC, that Saudi Arabia agrees to cut back on oil production. I think that's quite likely.
Which would drive up the price.
Which would drive up the price somewhat.
Well, let me ask you this question then. One of the big issues now in the presidential election, and Donald Trump has made this a huge issue, is that he is going to, if he were to win the presidency, take it to China.
Yeah, I think that's a real mistake. Yeah.
So, I mean, if you believe that Donald Trump possibly could win the presidency, maybe stay out of energy stocks?
That might be too tenuous. He's such a wild card that I don't really know what the hell he's going to do. I mean, he'll get in there. If he does half of what he says, then we're going to get in World War III. It's ridiculous. You can't treat other countries like that. And to stick it to China is the dumbest thing. I mean, we benefit so much from our trade relationship with China. I wish people had a better understanding of how important trade is. But apparently all of these candidates are against it.
Well, because they sit there and they're trying to appeal to the average Joe who sits there and someone tells him, oh, the reason why that factory left is because that factory went to China.
Right.
Now, what do you tell that average Joe?
I say, you don't realize that there are more factories, there are more jobs as a result of that going to China over here in the United States. Because what we're doing, we benefit for two different ways. We benefit because the imports are cheaper and then what we would have produced domestically. So whoever's using those products benefits, whatever Americans are using those products. Then we also benefit because whatever company is setting up their plant over in China instead of the United States is going to be is doing it presumably because they're going to be paying less for it over there, so they will have excess capital as a result to invest elsewhere. It naturally. You don't even think about it conceptually. Just look at countries that have shut down all their trade and see how successful they've been.
Cuba, North Korea.
Yeah, right. Look at them. Yeah. That's the most obvious economic failures on the planet are those countries. Do we want to do that? That's ridiculous.
Well, I think again,
the freest ones are the opposite.
Well, because here's the thing that always comes down to it, Donald Trump always comes on and he sits there and says the people who'd made these trade agreements were idiots. They were morons. They got schnook. Yeah. They were, China got everything that they wanted, and we basically walked in there with the biggest idiots in the world, and we signed whatever they put in front of us because we're the dumbest. They sent the dumbest human beings, whereas I'm the best negotiator in the world. I would have gotten a better deal.
That's his line, right?
Now, you're saying no, they got a good deal because they got those cheap products over here. So, for instance, one of the big things always people talk about is Walmart, and they say, well, part of they have the big thing, is Walmart good for America? And they'll talk about the fact that it's bad because you're right, XYZ plant might have left and gone to China, but because of the fact that person can now buy that T-shirt at $10, whereas if it was produced in Millville, Pennsylvania, it would be $30. He now has more buying power, so now he can drive the economy in other places besides just buying his T-shirt.
Correct. And it gets allocated more efficiently that way because we don't have a worker who's like pumped to earn $5 a day, whereas in China they're totally pumped to earn $5 a day. So that worker is delighted, and we are getting a lot of excess capital to allocate to areas where that suit our needs better. We'll get jobs, higher tech jobs that somebody's making $100,000 a year and they're pumped. That can be the result of outsourcing, actually.
And then, but the problem is to that guy who.
Right. He doesn't have the education to get that job.
He doesn't have. He sits there and says, well, they used to make steel over there. Now I don't make no steel no more.
Okay, and I agree. That's a very real problem, and I don't really have a good solution to it.
But overall,
there are people, and I think that's a lot of Trump voters.
Yeah.
I mean, people who are really disenfranchised like that, and feel like out of place. They don't have a place. They're not a cog in this machine, and that's a complex problem, and I don't really have a good.
But ultimately, in this conversation we're having right now, though, is if you're sitting there saying, because to me, the number one thing that, like you said, world events that could happen would be we elect a new president who takes us in a different direction than we are right now. It sounds to me that the one person who actually, in my opinion, has a chance to kind of keep things moving in one direction that we're on is Hillary Clinton. And then you have Bernie Sanders and Donald Trump, who are kind of, in my opinion, still in the race. I don't feel this is just Mike Sasson. But he's still theoretically.
But she has over the amount of delegates.
So right now it's Hillary or Trump. I mean, Ted Cruz
that's
kind
what I
of.
think.
But I mean, right now, if you're thinking Hillary, you're thinking, okay, things are going to keep moving
Right.
in a direction right now that's going to be whatever. Trump is the wild card to where, like, if you really think that. Now, let me ask you this question: are you investing in anything if you believe Donald Trump is president?
Wow. I think if Donald Trump is president, that's very bad for Wall Street. Just because we don't like uncertainty. Investors don't like uncertainty. I don't mean I'm part of Wall Street.
Well, investors in general, yeah.
Investors in general, yeah. And he brings a lot of it. Hillary, at least we know where she's coming from. And, and she's not totally against Wall Street like Bernie Sanders. Even though she had to say some things that were very investor unfriendly during the primaries, I would not be surprised to see her rhetoric change during the general election. So,
I would argue her campaign finance report would be a Republican's wet dream.
Yeah.
Well, then let me ask you this: in terms of this, the other wild card, at least in my opinion, outside of Saudi, is Russia and Vladimir Putin.
That's a wild card.
Now, is he? Are you putting him in the same boat as almost like a Trump in a sense of we don't know what the hell this guy's going to do? Because right now, what I understand is their economy is so based on oil and gas prices that if they don't start bumping up, you might see him doing something crazy as well.
They are backed against the wall, and it's amazing that they spent so much on military recently at a time when they're taking in so little in tax revenue. So I do think Russia's dangerous and a wild card, and I agree with that assessment. Putin is, I don't know if he's as a wild card as Trump, because Putin's been in office for a long time, and we kind of have some pattern to his behavior, but he is a very odd leader and difficult to deal with.
Well, the thing that, in terms of a wild card, is like, for instance, what he did in Crimea. That was because of oil and gas. That was their entrance into the Black Sea, which could get into the Persian Gulf. I mean, that was why they took that over, is because that's where the fleet was.
Right.
And so, like you said, once someone's back is against the wall, then it's like, okay, what the heck could this person do? And that's why when it comes to investing, it's almost like that's where you say, okay, what could possibly hurt or help energy prices? Obviously, number one, the scenario that we hope happens, China's economy comes back, obviously gas prices get to a certain level to where people are starting to make money again. Now, let me ask you this question, stop that question, but now new technologies. And is it so small of an influence, and it would only be in, let's say, Western countries in America, that because of the fact that those technologies wouldn't hit China, that it really wouldn't, if we all just started driving Teslas and Priuses, it really wouldn't affect that much?
Well, I mean, I think it would. But yeah, there is still, then you have, if we're all buying more expensive cars that use alternate, to fossil fuels, and then the emerging markets are continue to buy the fossil fuel vehicles. Yeah, that could be like a wash, maybe. But and you'll see, though, I think that there is some what they call demand destruction going on in the highly developed Western Europe and United States and Japan. That are going more to electric, and ultimately that's not really even not fossil fuel either, if you think about it, right? Because they're either burning coal or gas somewhere to make that electricity. So, but it consumes less, though, is my understanding. And
it makes you feel better, and it makes you at least perceive yourself as a better person.
Yeah, right. Right, it's like that South Park episode.
Yeah, like you run on smug.
Smug, yeah. All right, so that's it. I would say Hess is my favorite of these four, although Concho is still good and worthy of looking at. Hess, I'm definitely going to keep an eye on, and that's the one that I will look at first to pull the trigger on. I do own one energy company currently. And it's Gazprom, the Russian gas company, and that's you were talking about Putin. but I would. That's really not for the faint of heart. You gotta. What Putin does matters dramatically to that company, and he's pretty unpredictable. So Crimea actually was terrible for Gazprom. But at any rate, I think it's a good idea to always be looking in down markets for really downtrodden, picked over left stuff. You'll find something good. And Hess could be one of those. We'll see. It's trading below book, so I like it. So I was very pleased to have our guest with us today, Mike Sasson. Thank you for
having
coming.
me. Thank you.
Yeah, real quick, don't forget to stay tuned after today's show to catch Awesome Cast. I'm a guest on Awesome Cast this week, so I'll be there talking about phone chargers and other sorts of gadgety things. Matt Geika with Geik's Got Game tomorrow morning at 7 a.m. He's recording live it's a live-to-tape recording in Bradenton, Florida, covering the Pirates. And
that's awesome.
Then, this week, Friday, after Geik's Got Game, we have Talion, who's a great metal band performing at Heavy Metal Monessen, which is Saturday, April 23rd at 1 p.m. at the Monessen City Park Amphitheater. And then Monday morning on River Talk, we have Claymore, Lee Prisby of Claymore, who's also performing at the Heavy Metal Monessen 3. So don't forget to check those out.
Nice. That's going to be great. So anyway, we're all out of funny money. Good night, and thanks for listening.
Get your weekly weather forecast every Monday morning on River Talk at 6 a.m. with me, meteorologist Heather Nevels, broadcasting from Millville Studios on the River's Edge Radio Network.